Welcome, everybody. Shane Carter here, Hampshire Capital. With me, as always, our VP of Operations and Investor Relations, Eddie Austin. How are you doing today, Eddie?
Man, I'm doing great. It's another good day and another fun day to talk about real estate and geek out about funds.
Man, first of all, I love talking about real estate. You know that. That's my life passion.
Yep.
And you have also spurred in me a deep passion for funds, diversified funds, and fund management. So what are we going to talk about today relative to funds?
Oh, man. So this is a subject I get all the time. And, you know, that's my game. I love the fun world. And I have people ask me, can I create a fund to buy build to rent or to do build to rent? Yeah. Can I do a fund to buy single family homes? Absolutely. You can do a fund however you want. And mostly it's what people don't understand is when you start a fund or you have a team that's helping you start a fund, you create a narrative. And off that narrative, you are actually writing the Bible that you abide by and what you invest in. So just like if we do multifamily, everybody knows about a multifamily fund. Oh, you know, Sovereign Wealth, it's a fund that invests in several different types of assets. Well, you can have a fund that's just for multifamily. But the cool thing now is people are starting to catch on to building a fund to not only invest in multifamily, but other asset classes.
Yes.
It's still real estate.
Now, why, I guess, what are the pluses and minuses of doing that, and why would you want to do that?
So I think, number one, people need to think about a fund is it's diversified. But normally it's diversified over one asset class, meaning multifamily. So for instance, when we first started building a fund, we did multifamily, class 3, class C through class A. Well, that might be in the North Carolina, South Carolina, and Florida region. So maybe we decide, you know what, we're still going to do real estate, but we're still going to do multifamily. Well, investing in a fund, you're going to be able to invest in not only the class C assets, but all the way to the class C assets. So that was that diversification across all of that. Well, now people are starting to catch on that, hey, why can't we do the same thing and do multifamily and maybe RV parks all in the same fund? Absolutely, as long as it's real estate related.
Now, would you think that that would be the same operators for those different asset classes, or are those different operators?
So I'm going to look at this from a lens as I'm an investor. So the very first thing I'm going to do when I'm looking at the PPM, the private placement memorandum of the fund, I'm going to look at the management team. And it's probably going to say Shane Carter. It's going to show all of his experience. It's probably going to show their asset manager and all of their experience. Well, if it's all about multifamily, I know that it's going to be a pretty good fund to invest in because I'm going to look at your experience level. So if you're to have a diversified fund that would also invest in RV parks, I would be looking for someone on the team or on the board of advisors that has done that inside of that area of expertise. I'm going to look for somebody that's an operator of RV parks or development or something like that. So I'm looking for someone on the management team that has that experience and a bio that kind of matches.
Okay, that makes sense. Yeah, and I guess the reason for bringing that up is, it can be challenging. It can be challenging for an operator to be an operator in multiple different asset classes, right? So yeah. To your point, you really need a savvy and astute fund manager and management of the fund team that understands how to what we call pick horses and jockeys, right? So pick the operators and the assets themselves, and so we're vetting the operators and we're vetting the folks who are running the deals, the individual assets, more heavily than we're actually underwriting and looking at the assets themselves. Because who's running the asset and how it's being run is, in our experience, far more important than the deal itself. Now, if you get a home run deal and you got, a tailwind market like we had, let's say, call it 2015 to 21, sure, everybody looked like a genius, but those times are over. right? And it's
Right.
it's back to basics. It's back to sort of how I started in this business, which is what we like to call blocking and tackling. It's just straight fundamentals and operations. It's all about operations, which is all about people. So
Right.
that's really what you have to drill into is who are the people you're doing business with? Who are the people that are running the assets? And further in, who are their people and how are they?
Exactly.
What's their track record and how well are they doing? Okay, good. I just wanted to make the distinction for folks that it's not a single operator in these different asset classes. We are choosing sort of best in class operators within each
Exactly.
asset class, and we're really vetting them as diligently as we would vet every single deal.
Exactly. Because it's all about the team, the operations team. So from the top down, you're probably going to have one or two people at the very top of your PPM when it comes to the team. One of them is going to have a tremendous amount of experience in fund management. One of them is going to have a tremendous amount of experience when it comes to operations and money and managing assets and business plans and stuff like that. You're going to have some really savvy operators. And then hopefully, if you're in a fund world, you're also vertically integrated. So meaning you would have a construction manager, you would have a VP of investor relations or someone on your investor relations team, someone that's taking care of marketing, stuff like that. So that would be a really strong PPM. And through that, on that RV park side, you have someone that's an RV park operator that's either a board of advisors or someone that actually is in that fund to help operate that. So that would be a good arm that we could reach out and we know that we could operate RV parks, because let's be honest, if we look at multifamily, you could probably throw a dart at the wall and pick out exactly what IRR returns, AAR returns are going to be. All those metrics are going to be pretty well the same.
Yeah.
But when you start talking about adding in RV parks, land entitlement, and these different types of things, you really start to juice returns. And, of course, you want the elephant in the room, right? You want the big multifamily apartment building front and center, that that's your good safety and security. But we know that those returns are not subpar, but they're less than they were a few years back.
Yeah.
So they're not as exciting to invest in. People are starting to choose other assets, or they're thinking, I'm going to wait until that return comes back up to a 24% IRR. You may be waiting a while.
Maybe waiting a long time.
Right, exactly.
Yeah.
But, however, as savvy operators, we've looked at different ways to diversify a fund, a 506c fund, meaning we're diversifying in multifamily. Probably going to be 60-70% multifamily.
Yep.
And then a really good diversification on land entitlement, taking raw land and handing it to a developer, per se. And then RV parks, because we did a video, a podcast a while back on the numbers on RV parks. Holy cow. Yeah. There's a huge supply issue.
There is.
And there's a big demand.
There's a big demand, and there's great operating margins on those assets. And there's literally only a handful of folks that are doing it the right way and in a scalable way.
Yeah, 100%. We met a gentleman at Best Ever Conference, and we sat down with him, and we were telling him about some of our opportunities in multifamily, and we expected him to kind of get on the edge of his seat and tell us, how exciting that was and everything else. He just kind of sat back with his legs crossed, and he wasn't very excited, and I couldn't figure out why. And then when I looked at the RV park opportunity, I was like, no wonder we never got him on the edge of his seat. He wasn't thinking about returns like, multifamily. He was thinking about the returns that he's done.
Yeah, that's right.
And he was impressed with our operational experience, but he wasn't impressed with overall returns from compared to what he could generate.
That's right. Yeah, and look, it's different, and the reason we're offering different classes of assets within multifamily is the same reason that we're offering different asset classes apart from multifamily, is that every investor has their own profile. Some folks are interested in more of a stable return. They're interested in more of a something they know. Maybe they know multifamily. Maybe they've been invested in it before. They know that it's a very evergreen thing. It's been around for hundreds of years and will be around for hundreds of years. But what we get excited about, we made another video on this, is something we like to call velocity of capital. And
Yes.
velocity of capital is where you are really looking for the best risk-adjusted return for your capital for any given fixed period of time. In multifamily, that's usually the value add process over the first 3 years, raising the NOI, increasing that value substantially, and then recycling that capital to do it again and again. And RV parks, to me, look like an opportunity for velocity of capital, and also in a young and burgeoning market, sort of like what short-term rentals were, a handful of years ago, that they were sort of up and coming, but nobody really knew about them. But boy, the folks who dove in, they're doing really well.
Oh, very well, 100%.
So it's all about getting with the right operators that have the right plan and ability to scale. Right, any short-term rental or any RV park, for it's different asset classes in and of themselves, the returns are fine. But it's when you can do the second, the third, the 10th, the 20th, that's when it really gets exciting.
Right. Now, just a little caveat or segue here. When we think about bonus depreciation, by submitting a cost segregation, if you were not diversified in your fund, you probably couldn't offer near the tax advantages like we can on a 400 plus unit apartment building, the same as someone buying a 200 pad RV park.
Yeah.
I'm sure, we haven't really dug into it, but I'm sure that there's a big difference between the two as far as bonus depreciation.
Yeah, there is. Yeah.
Because
right.
when you're depreciating carpets and roofs and doors and concrete all differently, there's a lot of items there that you can grab in that engineered appreciation schedule or depreciation schedule, and you don't have that on an RV park.
That's right. That's exactly right. Yeah. So that's why, again, back to, I think, the overall topic of discussion today, which is having that blended return where you're getting some better depreciation over here, but then you're getting a better cash on cash or IRR metric over there. And you get those blended returns across different asset classes that make investing in a fund and investing in a diversified fund a really intelligent hedge.
Yeah, absolutely. I mean, you have the safety and security, and then, one thing does good, it feeds the other, and back and forth. And altogether, it just brings the returns up overall. And
Yep.
it's safety and security.
That's exactly right. Yep. And
So
that's
I'm
why, like you
excited.
said, the vast majority of what we are going to invest in with our fund is going to be, safe, stable, secure multifamily assets that we know we're getting in at the right basis. Coming up here over the Q3, Q4 this year, we know there's a lot that's going to hit the fan, so to speak, and we'll certainly capitalize on that. But then also being able to offer outsized risk-adjusted returns by using some of the capital, smaller amounts in our fund, to do some real, high-dollar return items like the land entitlement process and some of these RV park opportunities as well.
Yeah, absolutely.
Yeah, pretty
It's going to
exciting.
be very exciting.
Yeah.
As always, anyone that has any questions or anything that they would like more in depth on the topic, please, by all means, reach out to us. We're happy to cater to anything that is along the lines in our wheelhouse of experience. So please, by all means, like and subscribe, and make sure you share this channel with someone else, because it could help someone else in the space. And also, if there's absolutely anything you can think of that would be a great idea for a new topic, please let us know.
Yeah. We love talking about this stuff. We love geeking out about this stuff. Eddie and I could go on and on for hours in each topic. I mean, we literally eat, sleep, and breathe real estate and investing every day. That's why I get up every day. And, we don't necessarily have to go to work, right? But we get to go to work. We get to do this, and we get to experience just all the joys and benefits of investing in real estate.
Yes, 100%.
It's so fun.
It's you could get up and go to work every day in a factory. You can get up and just work on your dreams every day, and then owning a lot of real estate. I've always said I want to own more real estate than McDonald's.
That's a lot because
yeah.
They are a big real estate company.
Yeah, I think probably pretty close to 3.7 or 4.1 billion dollars in real estate right now.
Oh yeah, I'm sure. Well, we'll get there, buddy.
Absolutely.
We're on our way.
All right. Thanks for the time today, Shane.
All righty, we'll talk soon. See you on the next one.